In traditional corporate finance theory, managers and investors are assumed to be perfectly rational. Financial decisions are made logically, markets are efficient, and securities prices always reflect fundamental values. However, reality tells a different story. Financial history is rich with examples, such as the dot-com bubble and the global financial crisis, that reveal how emotions, biases, and social dynamics deeply influence financial markets and corporate behavior. Hence, today's topic is behavioral corporate finance, how rational managers and irrational markets shape corporate decisions. Behavioral corporate finance acknowledges this complexity. It integrates psychology into financial decision-making, offering a richer, more realistic framework. In this short discussion, we will explore three key mechanisms. First, how rational managers exploit irrational markets. Second, how managers themselves fall into behavioral traps. And third, how managers signal using behavioral psychology rather than costly economic actions. Let us begin with the first. First, market timing and catering. Market timing refers to the strategy where rational managers recognize when their firm's securities are temporarily mispriced, typically overvalued, and act to benefit long-term shareholders. They issue equity when the stock is overpriced and repurchase shares when undervalued, transferring wealth from new investors to existing ones. Catering involves taking actions that appeal to prevailing investor sentiment, even when these actions may not improve long-term fundamental value. Managers might, for instance, adjust strategies, initiate dividends, or even rebrand to ride current market trends. Managers are not merely passive participants in financial markets. They are rational opportunists in an irrational world, said Baker and Wurgler in 2012. For example, during the dot-com bubble, several traditional companies added .com to their names, such as Books-A-Million.com, and saw their stock prices soar without any substantial change to their business model. In recent years, firms have increasingly promoted their ESG initiatives by emphasizing sustainability, even sometimes superficially. They cater to investor demand for ethical investments, enhancing short-term valuations. Second, managerial biases. While managers may exploit market irrationality, they themselves are not immune to behavioral biases. Two of the most common are overconfidence and optimism. Overconfident managers overestimate project returns and underestimate risks, leading to overinvestment and a strong preference for internal financing. The greatest enemy of knowledge is not ignorance, it is the illusion of knowledge, said Stephen Hawking. For example, the collapse of WeWork in 2019 illustrates managerial overconfidence. Its founder pursued aggressive expansions based on inflated valuations and overestimated market demand, ultimately leading to one of the most notable IPO failures of the decade. In the current venture capital landscape, many startups continue to burn cash excessively, fueled by founders' over-optimistic projections, highlighting the persistence of managerial biases. 3. Behavioral signaling. Traditional signaling models argue that companies prove quality by bearing real costs, such as high dividend payouts, despite tax inefficiencies. Behavioral signaling offers a different perspective. It suggests managers can signal by appealing directly to investor psychology without necessarily destroying value. Investors are not simply consumers of information. They are emotional beings whose perceptions of gains and losses shape markets. Adapted from Kahneman and Tversky in 1979. For example, a company might increase dividends not because it has excess cash, but because it understands that loss-averse investors interpret dividend cuts negatively. A steady or increasing dividend reassures investors and signals financial health without heavy economic sacrifice. Today's issue. Facing political backlash against stock buybacks, companies increasingly use dividends and ESG certifications as behavioral signals, tapping into investors' emotional valuation of stability and ethical commitment. Behavioral corporate finance reveals that corporate decision-making is far richer and more complex than traditional models suggest. Sometimes, rational managers exploit irrational investors. Other times, managers themselves are swept away by biases. And in many cases, signaling strategies are carefully crafted not just to inform, but to resonate with the emotional frameworks of investors. Understanding these dimensions is crucial for anyone who wishes to truly grasp how real-world finance operates. But to fully appreciate how these behavioral mechanisms evolved, it's important to look back at where it all began. Before this sharper categorization emerged in 2012 with the title of Behavioral Corporate Finance, a current survey, the field was first structured in a more foundational way. Let's rewind to Behavioral Corporate Finance, a survey in 2005, when Baker, Ruback, and Wurgler first introduced a groundbreaking framework that split behavioral corporate finance into two powerful forces: the irrationality of investors and the irrationality of managers. Their 2005 paper did not just propose that psychology matters, it asked a deeper question. Where does irrationality truly originate? In the market or inside corporate decision-makers themselves? Understanding this original framework gives us a clearer view of how today's behavioral finance theories have grown. Therefore, the second topic is behavioral corporate finance, the two forces that shape corporate behavior. In 2005, Malcolm Baker, Richard Ruback, and Jeffrey Wurgler published Behavioral Corporate Finance, a survey. This was one of the first major attempts to systematically incorporate human psychology into the study of corporate financial decisions. It showed that sometimes markets are wrong, and rational managers must adapt to them. Other times, managers themselves are the ones whose biases lead to flawed decisions. Understanding these two forces, they argued, is essential to truly understanding corporate finance. In traditional corporate finance, both investors and managers are assumed to be rational, unbiased decision makers. However, this paper challenges that view, suggesting that markets and firms are shaped by psychology, by emotions, misperceptions, and biases, both among investors and managers. Behavioral corporate finance is divided into two powerful perspectives. 1. The irrational investor's approach, rational managers reacting to irrational markets. 2. The irrational manager's approach, irrational managers acting even when markets are rational. 1. The irrational investor's approach. In this first view, managers are smart and rational, but markets, they are not. Investors overreact, underreact, and misprice securities. And crucially, limits to arbitrage mean these mispricings persist. Managers, seeing these inefficiencies, respond by catering to investor sentiment or timing the market. They balance three goals: maximizing real firm value, catering to temporary investor fads, and exploiting mispricing through financing decisions. A direct quote from the paper summarizes it well. Managers balance three objectives: fundamental value, catering, and market timing. For example, investment policy. Firms overinvest when stock prices are high, even without better real opportunities. Mergers and acquisitions. Firms use overvalued stock to acquire others, preserving value before reality catches up. Equity issuance. IPO waves like the tech boom in 2021 show managers issuing stocks when valuations are sky high. Today's example, think about the SPAC boom of 2021. Companies rushed to go public via SPACs, exploiting high investor enthusiasm and arguably overvalued market conditions. As sentiment cooled, Many SPACs collapsed in value, illustrating exactly how managers time market euphoria to raise cheap capital. Thus, under this approach, markets are not always wise, and managers are opportunistic yet rational. 2. The irrational manager's approach. Now, flip the story. Suppose investors are rational, but managers themselves are biased. They are overconfident, overly optimistic, or suffer from bounded rationality. A key insight from the paper explains, we are concerned with situations where the manager believes he is maximizing value, but is in fact deviating from this ideal. In this view, overconfident managers overestimate project returns, leading to overinvestment. Financial policy shifts. They prefer internal financing because they wrongly believe external investors undervalue them. Behavioral patterns like bounded rationality and reference points distort managerial decision-making. Today's example, look at Elon Musk's acquisition of Twitter, now X, in 2022. Analysts pointed to overconfidence. Musk insisted on an aggressive $44 billion deal, arguably overestimating synergies and underestimating operational challenges. Post-acquisition struggles suggest how managerial biases, even by brilliant entrepreneurs, can impact corporate outcomes, perfectly fitting the irrational manager's approach. Conclusion: why it matters. Understanding these two lenses changes everything. If irrationality mainly lies with investors, managers must be shielded from market pressure to pursue long-term value. But if managers are the ones irrational, strong governance and discipline are needed to steer them toward rational decisions.